Welcome to the deep dive. Okay, so we've got this really interesting pile of material here. It's all about trying to, figure out this whole stock investing thing, especially if you're just starting. We've got everything from the official financial reports, which, let's be honest, can look like some kind of secret code back, to helpful guides and even stuff from online forums where people are just trying to hash out how this all works. It really can feel a bit overwhelming, can it?
Oh, absolutely. Yeah, that feeling is super common. A lot of people are curious, right? They want to invest, they see the potential, but then they just sort of hit this wall, all the jargon, the complexity. It's a lot.
Yeah, you see the prices jumping around, people throwing terms around, and you think, how does anyone actually make a decision here?
Yeah.
Like, did I miss the meeting where they handed out the secret decoder rings?
Exactly. And you definitely don't want to be just guessing.
No kidding. So that's our mission today. We're taking all these sources you brought together, and we're going to, cut through the noise. We'll do a deep dive, pull out the really key stuff, the basics you need if you're brand new. The idea is to help you look past just the stock price ticker, right? And start to actually understand what's going on under the hood of a company. We want to give you a starting point for finding potential stocks by focusing on what a company's really worth, its actual health.
That's the plan. We'll unpack what companies tell us about themselves in those financial statements. They're legally required to share this stuff. And really importantly, we'll introduce this idea of finding a company's intrinsic value, its true worth, based on facts, not just market hype.
Okay, let's get into it. The sources talk a lot about fundamental analysis. Sounds important, I guess. But what is it exactly? And why should someone new to all this care?
Right. So fundamental analysis, at its heart, it's just about figuring out what a company is genuinely worth, that intrinsic value we mentioned. And you do that by looking at objective stuff, the company's performance, its health, its industry, the economy, not just its stock price today. Think of it like buying a house. You wouldn't just look at the asking price, would you?
No way. I'd be checking the foundations, the roof, the plumbing.
Exactly. You're assessing its real condition and value based on its size, location, how old the kitchen is, what similar houses actually sold for. You're not just getting caught up in a potential bidding war price. Fundamental analysis is like being that house inspector for a business.
Ah, okay. So it's about finding the real value, not just the popular price tag that might be inflated by, excitement or something.
Precisely. The stock market can definitely act like an auction sometimes. Popular stocks can get bid way, way up, maybe higher than their current business justifies. And at the same time, really solid, maybe less flashy companies might be trading for less than they're actually worth. Fundamental analysis is the tool set you use to try and spot those potential, let's call them bargains.
And the goal then is to buy when the market price is lower than that intrinsic value you figured out. Kind of like a safety cushion. The sources mentioned Warren Buffett's idea here, the margin of safety.
Yes, crucial concept, the margin of safety. It's highlighted for a really good reason. It means you're trying to buy at a significant discount to what you think the company is truly worth.
Why is that so vital?
Well, a couple of reasons. First, estimating that intrinsic value, it's not like an exact science. You're making educated guesses about the future, and you could be wrong.
Okay, makes sense.
Second, things rarely go perfectly to plan for companies, right? Unexpected stuff happens. That margin of safety is your buffer. If your valuation was a bit optimistic or the company hits a rough patch, that discount helps protect your investment. It's like finding that house you think is worth $300 Ks, but you managed to buy it for $200K. You've got a built-in safety net. Probably the single most important idea for this style of investing.
Got it. Protection first. Okay, so before we even get to the numbers, which can feel like the scary part one source really stresses something else, it says the absolute first step is just understanding what the company does. Like, how does it actually make money? What's the business?
Yeah, this is step 0, and it's so often skipped. People want to jump to the charts or the ratios, but honestly, if you don't get how a company earns revenue, what it sells, who its customers are, how it competes, then the financial numbers we'll talk about later, they don't really mean much. They're just numbers without context.
Right.
The source is contrast. Simpler businesses like Walmart or Target, they buy things, they sell things in stores and online. Pretty straightforward.
With more complex ones, think Microsoft software, cloud, hardware, games, or Amazon e-commerce, AWS cloud, ads, streaming. Lots of moving parts.
But even the complex ones aren't impossible to figure out, are they? The sources say you can use Google, YouTube, whatever to find explainers. Like if you were looking at Albemarle, you'd research the lithium battery industry first.
Exactly. You got to do that homework. Understand what's actually happening under the hood. This is the qualitative part, understanding the business model, the industry, the competition, the customers. It gives you the context for the numbers, the quantitative stuff that comes next. It's like checking if the car's engine even runs before you start timing it 0 to 60.
Okay, big picture first. Makes total sense. All right, now for the part that feels like decoding hieroglyphics. The financial statements. The sources focus on three main ones. Can we break these down simply? We can try. These are basically how companies report their performance and financial health. Standardized formats mostly. First up, the income statement.
Income statement. Okay, so like a company's profit report card for a certain time.
Exactly. Perfect analogy. It covers a specific period, usually a quarter, so 3 months or a full year. It shows you how much money the company brought in, what it spent, and ultimately whether it made a profit or loss during that time. It starts at the top with revenue, that's all the money from sales. Then it subtracts different kinds of expenses, and it ends up at the bottom line. Net income, that's the profit.
Revenue minus expenses equals net income. Sounds easy enough. What kind of expenses? His sources listed a few common ones.
Right. There's the cost of sales or cost of goods sold, COGS, that's the direct cost of producing whatever they sold.
Yeah.
Raw materials, factory labor, that sort of thing. Then there's selling, general, and administrative expenses, usually just called SG&A. This is a big bucket. It includes marketing, sales team salaries, office rent, legal fees, R&D sometimes, all the general running costs of the business, not directly tied to making the product.
And the sources mentioned something about accrual accounting for the income statement. What's that about?
Yeah, important point. Accrual accounting means revenue is recorded when it's earned, not necessarily when the cash arrives. So if they sell something on credit in December, the revenue shows up in December's income statement, even if the customer pays in January.
Oh, interesting.
And expenses are recorded when they're incurred, not necessarily when the bill is paid. This is different from just tracking cash, which we'll get to.
Okay, got it. Income statement. Profitability over a period, using that accrual method. What's number 2?
The balance sheet. Now, this one is different. It's not over a period. It's a snapshot, like a photo taken at a specific moment in time, say December 31st. And it follows one fundamental rule, an equation that always has to balance: assets, liabilities, plus shareholders' equity.
Assets, liabilities, plus shareholders' equity.
Wow.
Okay. Assets are everything the company owns.
Basically, yes. Resources it controls that have value. They get split into current assets, stuff expected to turn into cash within a year. Think cash itself, accounts receivable, that's money customers owe them, and inventory.
Okay.
And non-current assets, things held for longer than a year. The big one here is property, plant, and equipment PPE. Buildings, machines, vehicles.
What about cash and investments you mentioned?
Right. Cash is usually the first current asset listed. Investments can be current or non-current. If they plan to sell some stocks they own within a year, that's current. If it's a long-term investment in another company, like a subsidiary, that's non-current. Still an asset, though, something they own.
And things like brand names or patents. Those are assets too, right?
Yeah.
Intangible one.
Yes, intangible assets. Things like patents, trademarks, copyrights. They show up if the company bought them or bought another company that had them. There's also goodwill. That's a specific intangible that only appears when a company buys another business for more than the fair value of its identifiable net assets.
Net assets being assets minus liabilities.
Exactly. That extra premium paid becomes goodwill on the buyer's balance sheet. It represents stuff like reputation, synergies, things you can't easily list separately.
Okay, so assets are what the company has. Liabilities must be what it owes.
Correct. Obligations to others. Also split into current liabilities, debts due within a year, like trade accounts, payable money owed to suppliers.
Right.
And non-current liabilities, debts due further out than a year. Think long-term bank loans or bonds they've issued.
The sources mention some trickier liabilities too, like commitments and contingencies.
Yeah, good catch. Commitments are promises for the future, like a contract to buy lots of inventory later. They might not be on the balance sheet itself, but are important future cash outflows. Contingencies are potential liabilities, depending on something uncertain, like a lawsuit outcome. They only record it as a liability if losing is probable, and they can estimate the amount. Otherwise, it's usually just mentioned in the notes.
So keeping things conservative.
Very conservative. And they never record potential gains from contingencies until they're basically certain.
Okay. And that weird one.
Mm-hmm.
Unearned or deferred revenue.
Yeah.
Money they got, But it's a liability. How?
Ha! Yes, this one gets people. It is a liability. It's cash received for something they haven't delivered yet. Think magazine subscriptions. You pay for a year up front. The magazine company has your cash, an asset, but they owe you 12 magazines. That obligation to deliver is the liability unearned revenue. Each month, as they send a magazine, they move 112th of that liability over to revenue on the income statement.
Ah, because they've now earned it. Okay, that makes sense now. It's an obligation.
Yeah. Exactly. An obligation created by receiving cash in advance.
So, balance sheet. Assets, liabilities, plus shareholders' equity. What's the shareholders' equity part?
That's the owner's slice of the pie. What's left over for the shareholders after all liabilities are accounted for. It includes share capital money raised from originally issuing stock and retained earnings.
Retained earnings.
That's the accumulated profit the company has kept over the years instead of paying it all out as dividends. It's been reinvested back into the business.
Okay. And common shares, the sources say, let shareholders participate in profits, maybe through dividends.
Yes. If the company chooses to pay dividends, they usually come out of retained earnings and go to the common shareholders.
So balance sheet is the snapshot. What it owns, what it owes, what's left for owners. Got it. Third statement.
The cash flow statement. Now, this one tracks the actual cash moving in and out over the same period as the income statement. The sources really emphasize this one because, well, it's much harder to fudge the cash numbers than the accounting earnings. Cash in the bank is cash in the bank. Ah, the reality check. Where the actual money went.
Pretty much. It shows where cash came from and where it was spent. It's broken into three main sections. First, cash flow from operating activities, CFO. This is cash from the core day-to-day business.
Like collecting from customers, paying suppliers.
Exactly. It starts with net income from the income statement, but then it adjusts for things that affected net income but didn't involve cash changing hands.
Like that depreciation thing, you mentioned that.
Yes, perfect example. Depreciation is an expense on the income statement, right? It lowers net income.
Right. Wear and tear on machines and stuff.
But no actual cash leaves the company when depreciation is recorded. It's an accounting concept. So to get from net income back to actual cash generated, you have to add depreciation back.
Because the cash represented by that expense never actually left. Okay, add back non-cash expenses like depreciation. What else adjusts net income in CFO?
Changes in working capital. This is key. Remember, accounts receivable and accounts payable on the balance sheet.
Yeah, money owed by customers, money owed to suppliers. Right. If accounts receivable goes up, it means they made sales but haven't collected the cash yet. So that uses cash from an operating perspective. It's subtracted here.
Even though revenue went up on the income statement.
Exactly. If accounts payable goes up, it means they incurred expenses but haven't paid the bills yet. That preserves cash temporarily, so it's added back to CFO. Watching these working capital changes can tell you a lot about how efficiently the company is managing its day-to-day cash flow.
Okay, CFO is cash from the core business, adjusted. What are the other two sections?
Second is cash flow from investing activities, CFI. This is about buying and selling long-term assets. The big item here is usually capital expenditures or CapEx money spent on property, plant, and equipment, PPE. Buying new machines, building a factory. It also includes cash spent buying other companies, acquisitions, or cash received from selling off assets.
Okay, investing in the future or selling old stuff. And the third?
Cash flow from financing activities, CFF. This deals with how the company raises money and returns it to owners or lenders. So cash coming in from taking out loans or issuing new stock, and cash going out to repay debt, buy back its own stock, or pay dividends to shareholders.
Got it. Operations, investing, financing. The sources pointed out some specific things to watch for on this statement, kind of like warning signs or good signs.
Yeah, definitely. Net cash from operations, CFO, should ideally be consistently positive for a healthy company. That's the engine generating cash. Those changes in working capital we talked about. Big swings or trends can signal problems, maybe trouble collecting cash from customers or inventory piling up. PPE investment, CapEx, is crucial too. Is the company spending enough to maintain its assets? Too little might mean it's falling behind. Too much could be inefficient spending.
Right, need to keep the machinery up to date.
You need to figure out what's a sustainable level of investment for that business.
In the financing section.
Yeah, looking at the overall financing requirement or surplus. Basically, does the cash from operations, CFO, cover the cash needed for investments, CFI? If not, they need cash from financing, borrowing, or issuing shares. If they have extra cash after investing, they might use it for financing activities like paying down debt or dividends, a company that always needs external financing just to maintain itself. That can be a red flag. Shows the core business isn't self-sufficient.
Wow. Okay, the cash flow statement really does add another dimension. Looking at all three together feels essential.
They really do paint a picture together. Profitability on paper, the financial snapshot, and the actual cash movements.
Okay, so understand the business, decode the three statements. How does this help us find that intrinsic value thing? The bakery example in the sources seemed like a good way to get a handle on it.
It's a great, simple illustration. The core idea behind estimating intrinsic value, especially with something like a discounted cash flow or DCF analysis, is this. You try to estimate all the cash the business will generate in the future from now until, forever in theory, and then you figure out what that whole future stream of cash is worth today.
Because money later is worth less than money now, right?
Yeah.
The time value of a money idea.
Exactly. $1 today is worth more because you could invest it and earn something on it. The bakery example. Say it makes Jay $1 million in cash profit every single year, reliably. And let's say you need a 13% annual return on an investment like this based on its risk.
Okay, 14% is my required return.
A very simplified way to estimate its value today, assuming that cash flow lasts forever, is to divide the annual cash flow by your required return rate.
So J $1 million divided by 0.14 calculator, roughly J $7.14 million.
That's the basic idea. That J's $7.14 million is the price you could pay today to get that J $1 million every year forever and earn exactly your 14% return, considering the time value of money. Money received further out is discounted more heavily back to its present value.
So that J $7.14 million is the estimated intrinsic value in that simple case. And this is a basic discounted cash flow, DCF.
Yep, a very simplified version. Real company DCF models get much more involved, as the sources note. You usually project specific cash flows for, say, 5 or 10 years, making assumptions about growth, margins, investments. Then you estimate a terminal value for all the cash flows beyond that period. And you discount all of that future cash back to today using a discount rate that reflects the company's risk.
Sounds like there are a lot of assumptions baked into that. Growth rates, that discount rate. Seems tricky.
It absolutely is, and the sources are honest about that. Doing DCF well is hard. It requires judgment assumptions about an uncertain future. They even mention that some common ways to calculate the discount rate, like CAPM, can be flawed if not used carefully.
So it's not foolproof.
Definitely not. But the good news is resources exist. The sources specifically recommend looking at Aswaf Damodaran's work. He has free courses, spreadsheets. He teaches ways to approach DCF that try to address some of those potential flaws, using more robust inputs.
That's helpful. So valuation isn't just looking up a number. It's an active process of estimation.
Exactly. And that's why, as one source says, different analysts can look at the same company and come up with different intrinsic values. What matters is that your analysis, based on your work, gives you a value range you have confidence in and lets you see if the current price offers that margin of safety.
Okay, so putting it all together, understand the business, analyze the financials, estimate the intrinsic value. That sounds like a lot more work than just watching stock prices wiggle on a screen.
It is. Definitely more involved. And these sources point out the downsides. Fundamental analysis is time-consuming, no doubt about it. It relies a lot on historical data from those statements, and the past doesn't always predict the future.
And it can be a lagging indicator, right? The price might move before the good or bad news fully shows up in the quarterly reports.
That's a real limitation. Plus, it depends on accounting practices. While there are rules, GAAP, IFRS, companies still have choices, and sometimes things can be presented in ways that aren't immediately obvious.
Like that old issue with capital leases being kept off the balance sheet.
Exactly. That made some companies look less indebted than they really were. The rules changed, thankfully, but it shows you need to understand the accounting a bit. That book by Shillett is supposedly good for spotting potential red flags in accounting.
And what about stuff that's hard to put a number on? Like a great brand or amazing management, the Steve Jobs effect or something. How does that fit?
That's another big challenge. Intangibles like brand value, strong company culture, visionary leadership. They are incredibly important for future success, but very hard to quantify precisely in a model. Same with economic assumptions about the future. You have to make your best judgment call based on your qualitative understanding.
Okay, so if this is about finding value, maybe buying cheap, Why do we see stocks trading at crazy high prices sometimes, like 100 times earnings or even 1,000 times?
Yeah, those sky-high valuations. It's because the market is betting on absolutely massive future profit growth. The YouTube source had that great point, paying 1,000 times current earnings. If profits stay flat, it takes a millennium to earn back your investment.
1,000 years, wow.
People pay that because they believe profits are going to explode upwards, making today's price look reasonable later.
But that's a huge gamble in the future.
Huge and incredibly risky. If that growth doesn't happen or even just slows down, those stock prices can crater. The sources mentioned examples like Tesla's volatility, GameStop's wild ride, Adani Green's correction. Prices built on hope can fall fast.
So the big takeaway seems to be, price is what you pay, value is what you get. And they aren't always the same thing. Just chasing a rising price or following tips is super risky.
That's what the sources strongly suggest. It's not fundamental analysis. Doing even a basic fundamental check first can help you avoid getting caught up in hype and potentially losing a lot if reality sets in. It grounds you.
Okay, this is really helpful framing. If someone listening is feeling like, okay, I want to try this, where do they start? It feels like a lot of potential reading and learning.
It is, but you start somewhere. First, the sources say only invest with disposable income, money you can truly afford to lose without impacting your life. Rent money, emergency fund, off limits.
Absolutely critical.
Second, commit to learning and reading before jumping in with significant money, especially if you want to pick individual stocks hoping to beat the market. It takes time and effort, much more than just buying an index fund.
So what should they read or watch? The sources had a bunch of suggestions.
Yeah, maybe start with an overview, like that Bill Ackman video mentioned. Then dive into books by successful investors. Maybe start with the easier reads first. For accounting, which is key, they suggest David Krug's courses or Aswaf Damodaran's Accounting 101 and Shailett's book for spotting accounting tricks.
And for the valuation part, the DCF models.
Again, Damodaran comes highly recommended for his valuation courses and spreadsheets, partly because he tackles things like the discount rate in ways the sources consider more robust than some simpler methods.
Okay, that gives a learning path. But how do you even find companies to look at? Thousands out there.
Good question. One way is to follow investors who share their research. The sources listed some blogs. DK Value Investing, Damodaran's blog, Stock Chartist, Macro Ops, UK Progressive Research. Reading their analyses can spark ideas. And don't just look in your backyard. Consider international markets. The sources listed exchanges in the UK, Australia, Canada, Europe, Poland, Germany. Broaden your horizons.
International investing. Okay. And tools. Are there ways to filter stocks?
Yes, stock screeners. They let you filter thousands of stocks based on criteria you set, like industry, profitability, debt levels, maybe certain valuation ratios. The YouTube source mentioned one called Ticket as an example, noting it shows forecasts and often has free trials so you can play around. Screeners help narrow the field.
That's a ton of places to start. The main thing is just starting, right? Pick one thing and begin.
Exactly. Just begin. And remember what one source said. The knowledge you gain researching companies, even ones you don't invest in, it compounds. It builds your understanding of business and industries. That's valuable in itself.
Wow. Okay, that was definitely a deep dive into getting started with fundamental analysis. We covered a lot. Understanding the business first, then the big three financial statements. Income statement for profit, balance sheet for the snapshot, cash flow for the actual cash.
And we hit that crucial idea of intrinsic value, why it matters more than just the price tag, and how cash flow gives you a clearer picture sometimes. Plus, remembering the qualitative side matters too.
And we saw that, yeah, it takes work, it has limits, but fundamental analysis seems like a much more solid approach than just gambling on price movements or tips. Lots of resources out there if you're ready to learn.
The core idea, investing, is buying a piece of a business. So focus on understanding the business.
So for you listening, if you felt intimidated before, hopefully this gives you some tools. You can start looking under the hood yourself. You don't have to be overwhelmed. Start with the basics of what makes a company work.
So maybe instead of asking, what stock should I buy? The really provocative thought to leave you with is, what business should I try to understand next?
That definitely feels like a more powerful place to start. Until next time.